What if I told you the inflation number everyone feared this week actually came in better than expected? And what does that mean for your mortgage rate heading into the holidays? I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. This week brought us the highly anticipated September Consumer Price Index report. Remember, this data was delayed because of the government shutdown, but they had to get it done for Social Security cost of living adjustments. Here's what happened. The headline inflation number rose 0.3% for the month. Year over year, it went from 2.9% to 3%. Now, most estimates expected it to jump to 3.1%, so we didn't see things get as bad as many feared. But here's the number that really matters. The core inflation reading, which strips out food and energy, came in at 0.2% for the month. That's 0.2 on a rounded basis. Year over year, the core dropped from 3.1% to 3%. Market estimates were expecting it to stay at 3.1%, so this was actually good news. What drove the headline number up? Energy prices, specifically gasoline, which jumped 4.1% in September. But let's talk about what really matters for families. The shelter component makes up 44.4% of the entire core index. So the way shelter goes is often the way these monthly readings go. Owner's equivalent rent finally came down to earth at 0.14%. This is where they ask homeowners how much they could rent their homes for, unfurnished and without utilities. This number had been running hot, but it's finally reflecting more realistic rent numbers we're seeing in the market. If you analyze the rent increases we saw, it comes out about 2.4%. That's not far from what we're seeing in other housing data. Hotel prices did pick up in August by 2.6%, but we're seeing stories about hotel prices coming down as we move past the busy summer season. In fact, Hilton just lowered its full-year outlook this week due to declining U.S. bookings. Let's talk about what's happening in the housing market. Existing home sales came in at 4.06 million in September on a seasonally adjusted basis. Subheadlines called this a blowout, but let's maintain perspective. We're still at 2008 housing bust levels. What's interesting is how the market is shaping up. Last month, homes over $1 million commanded 8.4% of sales, up 20% year over year. Meanwhile, the overall market is stuck at recession levels. This tells us we're in a very bifurcated market. The good news? Mortgage rates dropped to 6.19% according to Freddie Mac, a 2-year low. History shows us that when rates decline, we typically see short bursts of housing activity. We're likely seeing one of those bursts now. So what does all this mean for mortgage rates going forward? The bond market responded positively to this data. We're already at a 100% chance of a 25 basis point rate cut at the Fed meeting next week on October 29th. After this CPI report, the odds for another 25 basis point cut in December moved into the mid 80% range. So those numbers are all baked into the numbers as well. Mortgage rates are hovering around 6.18% for a 30-year fixed right now. We're at some of the best levels we've seen in over a year. The spread between mortgage rates and the 10-year Treasury has been holding steady, which is what we like to see, or it contracting. The 10-year Treasury is testing that 4% level right now. If we can stay below 4%, we could see yields move lower toward 3.92% and maybe even down to 3.8%. That would bring mortgage rates down further, potentially testing the low 6% range or even the high 5% range. Looking ahead to next week, we have a light economic calendar on Monday and Tuesday. Keep in mind that some economic data releases may still be impacted by delays from the government shutdown, so we'll need to stay flexible with timing. The big event is Wednesday's Fed meeting at 11 a.m. Pacific, followed by the press conference at 11:30 a.m. Pacific. We'll also get pending home sales data on Wednesday. Thursday brings us the first look at third quarter GDP. Estimates are calling for 3.8% growth, which would be strong. We'll also get several weeks worth of jobless claims data that's been delayed to the shutdown, so we may see multiple weeks of data release at once if the government reopens. Friday wraps up the week with the September PCE report, which is the Fed's preferred inflation gauge. We'll also get third quarter employment costs and personal income data. Bottom line, This week's inflation data was better than expected. Shelter costs are finally coming down to more realistic levels. The Fed appears ready to continue cutting rates, and mortgage rates are near their best levels in over a year. The housing market is still stuck at low volumes, but we're seeing signs of life as rates improve. For families looking at their finances, whether you're thinking about buying, refinancing, or repositioning equity, now is a good time to explore your options. Remember, we help families with all their home financing needs. We look at the complete picture to find the right strategy for their situation. Remember, strategy beats rate always. Have a great weekend, and we'll speak to you again next week.